Welcome to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome to our Avenue third quarter investment letter update. Bryden's written a great essay on gold. This is slightly unusual because we're just going to pick one topic and dig into that. But first I'm just going to give a high-level summary and then we'll get into a deeper discussion. So highlighting the big themes this year in the market are artificial intelligence, a huge amount written on that. And the other big theme is the extraordinary move in gold, and we've been able to capture a lot of that move in our portfolios. So just wanted to highlight gold is considered historically, it's this 2,500-year-old hard asset, and the trickiest thing in investing is it seems like gold is going up, but if gold is actually the currency and is the monetary unit, maybe actually everything is going down. So, you know, the value, this is an inflationary period where gold is sort of anchors the value of everything, and then everything relates to gold. And so it's sometimes in financial markets, it's very tricky to sort of understand which is the piece that you think something's going up, but actually everything else is in the process of being devalued. So that's just another way of just trying to get our heads around thinking about how investing in this asset class. So the couple main reasons that have changed over the last few years, and certainly why we liked having our gold position as a diversification within our portfolio. The big one is just big government debts, specifically in the US, but also Europe. It's a phenomenon around the world, big deficits and more debt accumulation. The second one, which is, and we'll get into it in more detail, is when Russia went into Ukraine a couple of years ago, the Western world sort of ring-fenced its currency. And this is something that's new. You didn't have to do it. You could have said, here's your money, and you stay over there and we're going to stay over here. But they actually ring-fenced their gold, and this is around the world, said, oh, very interesting, from a non-Western world perspective, that might be me. And so there's been a big accumulation of gold in central banks. So first of all, big government deficits, central banks accumulating gold, and also the third point, which is really important, is that over the last 20 years, it got to the point that not a lot of people own gold because it was something that sort of sat in your portfolio and didn't do anything. So it's mostly coming from the perspective when the vision changes and away gold goes. So very difficult sort of asset to invest in. Historically, Avenue is in the business where we own businesses, we invest in the stock market and stock market businesses, and mining companies are depleting, are very difficult things to invest in. We have always liked what we call gold royalty companies, and the bulk of our gold investments have been in royalties, and we'll discuss why. The main two ones we own are Cisco Royalties, and we own Wheaton Precious Metal Fund. So now I'll throw it over to Bryden. You wrote a great essay, and just why were you thinking about gold just in this context, and why just focusing this quarter's letter on just that asset class?
Well, I think I was thinking about this in the summertime, but I guess at that point, gold had not gone up enough to make it sort of the central focus of the summer quarterly letter. And so, I think it was something that we've been getting a lot of questions on for the last year, couple of years, and especially with some of our investments in the gold space. I think it had become more topical through the summer as gold price has appreciated to the degree that it had. And so I thought from this quarter's perspective, it would be a worthwhile exercise to go through and sort of highlight gold, what we think of it. Avenue's had a long history of having some core position in gold, almost back to the inception, from, as you said. And I think it's topical to sort of reference why we think it's a relevant investment, and then we go into a little bit of the history behind that.
So a little bit of the history. So in a summary, but you actually went quite far back to detail that this is not a new asset class. And cryptocurrencies are all new, but this original money, and going right back to sort of how long ago we actually picked up.
Yeah, well, I think that sometimes gets lost on, even for myself, making sure that I'm always up to date on understanding a lot of this, but really the history on gold as a monetary asset and as a store of value, a currency essentially goes back several thousand years. And I think it's ultimately what we're trying to write about in the letter is get across, which is the same topic today and has been since several thousand years ago, is essentially it's the sort of consistency of value that gold had in people's minds as a consistent store of value. And it was something in the early ages where the different governments or different regions in what now is Southeastern Europe, governments can't print gold. That's always sort of the thing that you could say, is that you could have a reliable store of value or medium of exchange with gold because there was a consistent amount of gold ounces in each coin. The first dated period of relevance for this goes back to King Croesus, who was sort of the famous, very wealthy king who was essentially in what is now part of Turkey, and that's where they found the earliest gold coins, and where it was sort of originally documented as a key part of their monetary system. But the system then obviously proliferated even in early stage Europe, and then later stage 1700s, 1800s, officially when the UK went on the gold standard. It was part of Canada and the US's early monetary system. And I think because the system in North America has changed in the last 50 years, I think sometimes we're not, most investors aren't aware of the rich, long history gold had as really the central bedrock of the monetary system for hundreds and hundreds of years. And I think as we talk about further in the letter, that changed for some dynamics in the Great Depression, and then after World War II with Richard Nixon in 1971. But we can sort of go into that a little bit. But we don't have to bore everyone with all the history.
Yeah. Well, I think just touch on that though, and then we can go on to the investing side. But really, the currency, and even just not that long ago, our Western world currencies, Canadian dollar, U.S. dollar, was actually backed by gold. Gold is anchored at a price, and you said the system works, but until it was broken by the economy.
Yeah, essentially the original. I mean, there's a few reasons why originally Canada, the United States, and Europe were on gold standards, and it was sort of this. There's not been a belief in paper money always, and that you could actually, if you wanted to, or in times of crisis or uncertainty, anyone who had savings could go to the bank and trade in their physical cash, and in return receive gold. And essentially that's what would happen. You'd have bank runs, and depositors would say, I don't trust the bank. I'm not comfortable with what's going on. I'd rather have my gold back. And so you could go and exchange gold in that scenario. The challenge in the 1920s and into the 1930s is a gold standard is a very deflationary mechanism, in that governments can't create more currency if there's not a rise in the gold stock. And so the challenges in some of these boom bust scenarios in the 1800s is the government couldn't do fiscal spending like they do today because there wasn't enough gold in the banking system to back all of the money that then was being created. And so it was almost
borrow money.
Borrow money.
Borrow money to go spend money that you don't have.
The government couldn't just go borrow money because the gold didn't exist to back it. And so in times of recession or depressions or crises, there was no stimulus response. So there was no, the political economy of the last 50 years are, we have a recession, you have a central bank that cuts interest rates, the government does some kind of stimulus to sort of get the economy going again, but that didn't exist for several hundred years. And so, but the gold standard makes that much more challenging of an environment because the government can't go out and borrow money, essentially. That then changed in the 1930s, and we talk about in the letter how Canada went off the gold standard in 1931, the same time that the United Kingdom did. And then in 1933, the U.S. and President Roosevelt did his devaluation of gold, essentially, where we were talking about this just before, the government essentially forced private citizens to turn in their gold in 1933. And then the following year, essentially the Treasury of the U.S. confiscated it all, devalued it, in part of the effort to revitalize the economy in the 1930s. And so there's a very contentious history, for those that know about it, about the history of gold, the history of gold confiscation. All of those things did happen in the 1930s, and it's unimaginable, I think, for most people that gold was a relevant thing, and it's almost beyond imaginable to know that the government tried to confiscate it from everyone at the same time.
In a free market system, we've built this like myths of capitalism, free market system, but the points of time in crisis where you think it's yours and it's not.
Yeah.
And the government can be that heavy-handed, and we're in such an unusual debt deficit situation right now that you just don't know what's going to happen.
Yeah.
And it's fine that all your cryptocurrencies are fine, but then you can also regulate cryptocurrencies, you can regulate gold, and all these things are out there.
Yeah.
So, but I think also through that period of time, maybe we just go right into the investing is you still actually owning a gold mine. And I think that even though you couldn't own gold, individuals could actually have gold mining exposure. And certainly what we try to do is own these different gold mines around the world. And it's sort of jumping a few steps down, but let's just hit that, I'll from the investment side, it just got so unbelievably boring. It was a dead asset in your portfolio. And it just got to the point that if you weren't in financial assets, if you weren't in technology stocks, why did you have gold in the portfolio? And so I think it's just understanding just that's what happened. And we're such a low base, but it just go into the two main catalysts of what, what's changed going.
Yeah. So I think that's an important point too, that we try to highlight in the letter is essentially what changed since, you could say 2020, or what changed since 2022. And I think the concerns that we've talked about and are well documented elsewhere is rising government debt levels, and the historical implications are that, those generally follow periods of inflation, and gold has in times often served as a inflation protection asset because, again, if the government or, the fiscal agent, whether the government of Canada or the government in the US, they can do fiscal spending, can spend more money, borrow and then spend into the economy. So you can create more money. You're not necessarily creating more gold. And so hence, from your introduction point, things might be going up in dollar value, but relative to gold, things aren't. And that's sort of part of the dynamic that's happening right now. And then we had a run in gold after 2020, and the fiscal stimulus and the 0% interest rates became a concern that we were going to have inflation. And then as the economy recovered, that first wave of the gold and silver sort of petered out. And then what happened in 2022 that changed is when Russia invaded Ukraine, as you had mentioned, the US Treasury sanctioned the Russian central bank, which held a large chunk of their assets in US Treasury bonds, which essentially makes them unsellable. And so I think for non-US allied countries and central banks around the world, that was sort of a big shot across the bow to say, you directionally have to start allocating towards non-US assets or non-US dollar, and specifically non-US Treasury assets. And so we've seen an uptick in central bank gold buying in the last few years. And I think that, on the margin might be soaking up a little bit of the extra gold stock that's being produced. And then that sort of becomes a theme. And then you have investors who, to your point, were underallocated or completely disinterested in gold, or who, look at mining as over the long run, it's a really bad business to be in. It's hard to be consistently profitable as a miner. So you go through these cycles where the gold universe becomes much more challenging to invest in. And then in the last, 18 months, that started to change. And then since April and then the summer, we've had this sort of now parabolic, sort of almost panic move into gold. But I think as you were highlighting, maybe we could switch to, and you could highlight why we've favored the royalty businesses as a long-term asset. And I think it's one thing to say, gold has an important role to play in a diversified portfolio, but that's almost too simplistic, because then there's different ways that you can invest in gold. You can invest in, the physical ETFs, you can invest in the miners, but the way that we've chosen to invest is in the royalty companies. So maybe you could highlight why the royalty businesses are the businesses that we've preferred on an allocation perspective.
Yeah, from a long-term money management perspective, from the last 22 years of doing this, the way we will have from a 5-7% allocation in gold. Right now it's over 10 because the stocks have done so well, and that we don't think there's any particular reason to get out of them anytime soon, and they're doing exactly the function that we hoped for in the portfolio. Over time, we have owned companies, but in a depleting asset base, it really depends on the valuation when we made those investments. But as a few years ago, clearly what stood out on the sheet was these royalty companies. A bit of a Canadian invention, And what it is when you're at the beginning of a mine, it's hard, you want to get into production, but the bank's not going to lend you any money. So the first person that comes in and gives you money to get your project off the ground, you need 100 million, you need 200 million. There now, some of these, Franco-Nevada can actually write a check for $1 billion. And so they will give you the financing, but it's not a loan. They'll actually take the example is a 2% income stream off of the mine once it's in production. And then the advantage of that is that there's, it's relatively, you could argue it's expensive money, but you can't get money from anywhere else. And the advantage, the royalty company's taking the risk of putting that money in before everybody else, but they believe they've done their homework on this. And then once the mine's up in production, one, it probably lasts longer, and you also have a royalty on if you find more gold, and there's more gold in the area, and these things really have a much higher value if you're looking at 10 years, 20 years time. Now you also take that income once the mine goes into production, and they're not really dividending it out to us. At the end of the year, they go buy more gold, royalties. Invest. I'd say you're sort of investing in a new company, getting a new royalty stream. So what we like about it from a business, it's a dynamic thing. At the end of the year, you actually have more gold and more royalty streams than you have at the beginning of the year, and you beat that challenge of a depleting asset, and so it's a type of business that you really can sit on through the whole cycle, and I just say that you did a couple charts just showing Osisko royalties and Wheaton. Historically, we actually owned Franco-Nevada. I'll just touch on that. Franco-Nevada, it plays a bit of a game. It's got so much money now, and these are relatively expensive stocks. The market's figured out that these are great businesses, so they're expensive. And to get that money out the door, they're calling it a gold royalty company, but there's a fair amount of it now that are actually oil and gas royalties. But if we're going to have our precious metal exposure, we'd like it to be precious metal. But I've just described the two slides you've got on Osisko and on Wheaton.
Yeah, well, I think when you had come up and brought back the idea of looking at Osisko, I think what was attractive relative to Wheaton and Franco-Nevada specifically is that Osisko was predominantly, I think almost 80% of assets are in Canada or the United States. And so the other thing with gold investing or any mining investing or commodity investing in general is you have to be very cognizant of the jurisdictions that you're in, because there's obviously some countries are more favorable to, Canadian or U.S. companies producing, mines or running mines in those countries, and there are other countries that are less hospitable. And so geography matters, and I think the deepness of relations that companies have with the local municipalities and governments and stakeholders is important. So having Osisko be heavily weighted in North America, I think was very attractive at the time, a few years ago when we made the first investment. And the other concept that was critical at the time is because Osisko was still in the process of really starting to diversify and allocate some of its royalty assets, it was at a much better valuation. And the challenge where we had owned Franco, off and on for I think at least for sure the 12 years that we've worked together, I've worked with you, but the challenge with Franco is because it was the only royalty, it was always priced at a very high level. And so in good gold markets, it would get too expensive. And then in bad gold markets, it would never quite get cheap enough to make it really attractive. And then you'd be in a bad gold market, so you wouldn't be attracted to it anyways. And so the valuation on Osisko at the time was much more compelling. And then when we looked at Wheaton, which we've owned for longer, I think almost 4 years, it was the exposure to not only gold royalties, but also the principal amount of silver royalties. And essentially, same dynamic with Osisko, but we really like the assets that Wheaton have. A larger percentage of them are in South America, but we're comfortable with the jurisdictions that they're in. And we think having some exposure to silver royalties, I think, is attractive. And another topic we've talked about previously is just the increasing industrial demand for silver as it relates to electric vehicles, solar panels, and a lot of this technology infrastructure that use silver components. And so having some exposure to a silver royalty, I think was something we were looking for, and Wheaton really stands out because it's also got this bigger diversified gold royalty business as well.
Yeah, so again, very simple, just trying to distill it down to just let's have this precious metal exposure, but also just try to keep it as clear, as simple as possible. and know exactly what we own and why we own it.
Yeah, no, it was perfect. And yeah, that was great. And look forward to the next one.
Okay, thanks very much.
Thanks for tuning in to Avenue Insights. For more information, insights, or services, check out our website, avenueinvestment.com. Link in the description.